Welcome everyone to IGCA's latest webinar. Today we're going to tackle everything that is trending in financial crime and financial crime prevention. We have a very esteemed guest with us from Complyport, Martin Schoefield. And before I actually get started with the set of questions we have here for him to tackle, I'll get some admin issues out of the way. This webinar is being recorded, so we will have a full audio recording or video recording and a transcript available for everyone within a couple of weeks or so. And I will make sure to email that to everyone that is listening in and all those of you who actually registered and were unable to make it, unfortunately. If you have any questions for Martin as you're listening in to what he's saying, just make sure to use the Zoom control panel. You could just plop your questions in there, and I will either save them for the end of the session or I will work them into our discussion, depending on the type of question that is being asked. So that's all from me, really. I'll be moderating this session, but Martin will be sharing all of his knowledge and expertise with all of us. So to get started, I'm going to ask Martin to please, could you introduce yourself, tell us a little bit about your role, about your career in financial crime prevention, etc., and then we can get started with the questions.
Excellent. Thank you very much indeed. No pressure then. So you're going to ask me a lot of questions and I've got to come up with the answers. Great. So no pressure. Martin Schoefield, I'm the Director of Financial Crime and Forensics at Complyport. I've been a consultant for many, many years now, consultant and trainer in financial crime prevention, having previously held in-house roles as well as Group Money Laundering Reporting Officer, Group Head of Financial Crime Prevention, data protection officer as well, and also worked into little areas of sort of operational risk as well in some instances. So I've been kind of both sides of the fence. I've been practitioner and also consultant and trainer. I think when I first went into consultancy, the reason behind it was so that I could help other people coming into the business, already in the business, sort of like to not go through the same pain as I'd gone through, and to try and help people to learn from the lessons that I'd learned through my career. So now here to answer what questions that you may have and see what answers I can come up with for you.
Excellent. Thank you, Martin, for the introduction. Okay, so let's get started. I think we have about 7 or 8 questions here, and we have one entire section that is dedicated to, of course, the topic du jour, the topic that is in all of our minds, and it's on all of the headlines, which is international economic sanctions with everything that's going on with Russia and the Ukraine. So the first question, I guess, for Martin, within that context, what are some of the major challenges companies face when having to comply with sudden and massive economic sanctions? Martin, it's a loaded question. I know there's a lot to discuss there, but give us a little summary, I guess.
Okay, they're probably, off the top of my head, we'll break down into 2 or 3 key areas. The first one's going to be resource. It's important to remember that firms have been managing economic sanctions and trade sanctions and sanctions of all descriptions for many, many years. So we're used to it. Excuse me, but when we suddenly are faced with the level and the enormity of the sanctions that have been placed internationally across the board, from not just from the UK, not just from the UN, from the US, every other country is applying sanctions because everyone is joining forces to try and stop what's happening. So suddenly you're getting sort of upward of 1,000 sanctions being applied from a number of different countries. You don't have the resource on a day-to-day level to deal with the amount of screening that is going to now happen. You've managed your resource for the last X amount of years to deal with the kind of sanctions that are in place, the day-to-day sanctions, if you like, the ones that have been around, Cuba and things like that, Iran and all those kind of places. So we're used to that, and that's what we've planned for. That's what we budgeted for, and that's what we've got resource for. When you've suddenly got hundreds and thousands more sanctions added to that daily list, and the complexities of screening, and whether you've got like static logic screening or fuzzy logic screening, suddenly the amount of people you need to be able to review the output from that screening expands exponentially. And so you've either got to pull people off of other jobs in your teams, and you've got to get them to help, or you have to start training other people in-house to cope with that level of work, or this have a sudden influx of external people brought on board, temps, contractors, etc., to deal with it. The trouble with that kind of position, though, is that it's in a total state of flux. No one can say when it's going to change. When will those sanctions start to be released? What will drive the release of those sanctions? And will they be released en bloc immediately whenever everything is decided that it will be, or will they be phased out over a period of months or years? So, internally, the MLRO compliance officer is going to the board and saying, I need more staff, I need more money to get more staff. And the board's going, okay, fine, we get it. There's a big issue going on, and obviously it's serious. We need to do this, but how long for? So it's the chief finance officer's first question. Yeah, but how long do you want this extra spend for? This wasn't budgeted for. How much is this going to cost us? And where do we recover that money from? Because we've got to pick up the extra tab from somewhere. So that's probably the first and quite critical part that firms will be facing. The second is primarily around data. It's around the quality of their data. And the ability for that data to be used for screening purposes. Really, it's well accepted in most firms that they've got legacy systems. So some of their systems are dating back to the 80s or whatever. And the data that was put in those systems was never intended to be screened against sanctions lists. The way it's recorded. Joint accounts, for example, with joint accounts, you get Mr. and Mrs. whoever. Well, actually, there's no one on the sanctions list called Mr. and Mrs. whoever. So it doesn't matter if that person is actually sanctioned. You're not going to pick it up because of the way your data is being held and the way that you're using it to screen. So I think there's first of all, it's the data itself is potentially not suitable for screening. The way the data is recorded and held is not in the same format or suitable for screening. And it's the amount of data that you actually need to be able to discount a potential match. We don't necessarily hold. And I think that's an interesting kind of paradox environment to be in, because years ago, I do know from experience that firms would kind of over collect data. So it was okay, well, we don't actually need your national identity number or your national insurance number or your passport number for you to establish this product. But hey, if you're going to give it to us, we'll keep it because it's kind of nice, And bearing in mind, this was at the same time when the whole emphasis on customer due diligence was really starting to come to the fore. So there was almost this position to take of you can't know too much, you can never know too much about your customer. And just being sort of playing devil's advocate a little bit, that wasn't considered that much of an issue, because the more information you had about your customer, the better informed you were. The more you could identify suspicious and unusual activity. So firms were very keen to allow this to happen almost, because it helped them satisfy the money laundering regulations. And the only downside to that was the potential to be accused of over collection of data, unnecessary collection of data. And I guess, at the time, or pre-2018, pre-GDPR, in the UK, for example, the Information Commissioner could only fine you up to 500,000. So, the kind of the trade-off, the balance was, well, we can over-collect some data that we may or may not ever need. And if we are found wrong for that, then we could face a fine of up to 500,000. But if we did need that data to help determine whether this person, for example, was on a sanctions list, then that could stop us getting fines into the millions or billions. So the potential fine from the Information Commissioner was a bit of an acceptable trade-off almost. But then, of course, post-2018, post-GDPR, the fine for getting it wrong has gone up to 4% of global annual turnover. So suddenly it's not so appetizing to keep extra data that you don't need. It's not such a viable trade-off anymore. The risk is pretty considerable. So, but the downside to that risk materializing and for firms actually addressing that risk is that they don't necessarily have the level of data that they would like or need to be able to discount their customers' names from those on the sanctions lists. So it can be a real issue for that and for those purposes. So you've got screening, you've got the actual collection of the data in the first place. The design, I don't think any firm can honestly say all of their customer relationship management tools, databases, whatever, were built specifically with screening in mind. They're built with the product in mind. They're built with the, how do we need to collect the data? What do we want out of it? They never thought about, well, actually, what do we do if we need to screen the data? So there's always a lesson there that, the MLRO, for example, should always be involved in product development right from the start. So they can say, we need to put it this way so we can screen it. So there's the kind of, the nature of the data, the content, the actual data content, and the ability to have enough data to be able to discount matches. And then there's the other side of the data, which is, do we actually have enough anyway? I mean, for an awful lot of firms, for products and services, how would they know if someone has a Russian nationality, if they have dual nationality? How would they even know that? If someone presents a UK passport and they've got a UK name, but they're actually dual nationality with Russia, and that Russian part of them, if you like, is on the sanctions list, how would people necessarily know that? So there's those kind of issues that they've got to manage. And on top of all of this, or underneath all of this, whichever way you want to look at it, they've got business as usual going on as well. And then they've got the board saying, how long do you want these extra people for?
Right. So yeah, it's just it's an additional, I guess, block to carrying out your business. And with data also these days, I mean, a lot of the data that is collected is, a lot of it is used for marketing and sales and not necessarily for screening. So yeah, you're not actually collecting the data for that specific reason, as you mentioned. Excellent. So let's switch things around a little bit now. We spoke about the challenges and about some of the troubles that companies might actually face when it comes to dealing with these international economic sanctions. Now, what about solutions? How can firms undertake searches of sanctioned individuals and companies in an efficient and effective manner? And I'll also add a second question, which you brought up towards the end is, for instance, how can companies deal with dual nationalities and a lack of records showing that an individual has in fact two passports? So can you talk a little bit about the solutions to, dealing with these sanctions?
Yeah, certainly. I mean, the solutions, well, first of all, the overarching solution is know your system. I mean, we're all used to like KYC and KYB and all these kind of things, but actually KYS kicks in. Know your system. I mean, even as far back as 2009, the regulator in the UK undertook a review of a number of banks, small to medium-sized banks, and their sanctions screening protocols and their systems. And the overall finding they had is that people just didn't understand how they worked.
Right.
They could tell you when you said to them, so how do your screening systems work? They said, well, it kind of takes our data, the sanctions data, puts it together and tells us where there's a match. Yes, but how does it actually work? Where do you get that data from? Where are your data sources? Are they firsthand from, directly? Do you download directly from OFAC and from HM Treasury, for example? Or do you get them from another provider? Do they come, where do they come from? How would you know if your data is most up-to-date data, for example? And a lot of firms really, really struggle to understand, because the reason they struggle to understand how it works is because it kind of operates under that "it's not broken, so why fix it" rule. It works every day. We know we get alerts given to us to review. We discount the alerts and we deal with it and we move on and we wait for tomorrow. The trouble with that is a lot of these systems have been in place for so many years that the people that are now responsible for them maybe didn't implement them in the first place. So they weren't the one that chose the matching rules. They weren't the one that went through the matching parameters to see how best they actually could get the results through. So from that perspective, I have seen it myself. I've done it myself when I've conducted audits and things in firms. And so explain your matching rules. And firms say things like, "Oh, we have fuzzy matching." Yeah, okay, that's good. What does that mean to you? Well, it means it's fuzzy. Yeah, what does that actually mean, though? In reality, what do you mean by that? Well, it's an 80% matching rule. Okay, great, an 80% matching rule. What do you mean by 80% matching? Don't know. Okay, so do you mean 80% of the name has to match? Do you include middle names? Do you include known as names? 80% of the surname has to match? Do you have dates of birth? Is it compulsory that you've got to have every single letter in the name matching, or can some names have one or two digits different, allowing for mistyping, human error, and those kind of things? So all of those areas are where firms really need to get to grips with things. They need to understand, what do we actually do when we screen? What do we actually screen? What part of a name of our customer is screened? How much of it has to match? What does it actually mean when it comes out? And because a lot of the time, firms get an awful lot of potential matches coming out. So they will get all of these returns coming out that they've got to review, hence the need for all the resource. But sometimes that matching level, that review level, doesn't need to be at the level it's at. It's maybe the rules are not set correctly, the parameters aren't wide enough. And I fear for a number of firms that they just think, well, this is the product we've got, so we live with it, we work with it, instead of going back to the provider and saying, you know what, we want to go back to the drawing board and look at what rules we've got. and making the provider explain what those rules actually mean.
Right. And fine tuning it, I guess.
Yeah, and saying, okay, so, I mean, I would never advocate that the output is driven by the resource available to review it. It has to be the output is driven by the risk that you're trying to address. You have to find the resource to deal with that for sure. But sometimes there is so much call for resource, but in reality, there doesn't need to be. You just need to have, re-examine your matching criteria so that you get a more accurate response. I have personally seen firms where they say they have heaps and heaps of returns on a daily basis. And I say, why do you get so much all around this area? What's oh, that's a business model that we used to have, but we sold that arm of the business. And you think, okay, so but why are you still screening for names in that jurisdiction if you no longer have names in that? Why have you got such a heavy focus? You need to fine tune your matching rules a little bit so that your matching rules are aligned to your business model. And then so from there, obviously, a lot of the the issues that we said around screening with actual, knowing the names that you're screening for and all those kind of things, dual nationalities. Sometimes it comes down to having very serious conversations with the firm's data protection officer and saying, we need to revise our application forms, or whether they're online or hard copy. We need to start recording this data, whether someone does have a dual nationality, and if they do, where is that nationality? I don't think, if I'm honest, that well, certainly, for the longest time, no one could see what's going on now coming. So I wouldn't say you necessarily have to know the name that someone has if they carry a dual name, things like that. But just to have a box that says, if you have another nationality, what is it? And then people could put in a, British, Russian, American, whatever. And as long as you have the ability to search your databases for that keyword, then if at any time the sanctions list came out and said, right, anything to do with Russia, you need to identify your risk, then at least you could scan your database and say, okay, we've got X amount of companies that are declared to be Russian, and we've got 20 people that have either total or dual citizenship in Russia. And I think this is where the kind of nervousness comes from as well, is that we never know what the sanctions are going to do next. We kind of know, roughly speaking, what the regimes will do. So what the UK regime would do, for example, over the US regime. We know the US tend to do things on block, and they get a bit kind of, okay, we'll just do the whole of Russia eventually because that will be safest and easiest. Whereas UK and the EU tend to do things a bit more targeted. But I think what the nervousness that firms have is that question: what if the next sanctions order says anything Russian? And that's the kind of the problem that they face, is that they don't know how to identify anything Russian because they don't record anything Russian, or any other country, obviously, for that. And then the other side of that, the flip side of that, is that whilst we don't know if that's what the sanctions list will suddenly say, anything Russian or anything else, but we also need to be able to be prepared for that risk because of the reputational issue. And that's what we're seeing an awful lot of. I mean, I was talking to someone earlier and said, the public has almost become a quasi-regulator in this space. The public is getting very vocal, very active. I mean, I'm sure you've seen as well in the news, firms being boycotted and sort of almost placarded outside saying, don't shop here because they haven't done something against Russia. It's almost as if you don't do it, you're seen to be in support of Russia, well, say Russia, Putin. So almost, you have to be able to identify your exposure, even if the sanctions list don't actually say anything Russian, because the public still seem to be expecting firms to do something with anything Russian. So it's not just what the actual sanctions orders are saying at the moment, it's what the public are saying as well. And reputationally, confirms run the risk of falling foul of the public view. It's quite interesting. If you go back a number of years, if a bank was fined for AML failures, and on the newsstand outside the train station it said XYZ bank fined for AML failures, everyone would be like, oh gosh, no, look, that's awful, a bank's got everything wrong, they're terrible. Now it's happened so often that if the public see it, they just sort of go, oh, again, and walk on. They don't care so much.
Business as usual.
Well, it is almost business as usual. I mean, I would say, go and throw a stone in the city and you'll hit a bank that's been fined. Everyone's fallen foul of the rules somewhere. But those kind of things now, those risks, a bank getting it wrong and being fined, that's almost like, well, that's okay because it will be forgotten by tomorrow. The public don't seem to react to it. When certain banks were fined for falling foul of the OFAC sanctions in 2012, 2014. They didn't suffer the huge mass exodus of customers that everyone predicted they would, because customers kind of just looked and went, well, where would we go? To another bank that's been fined? Who cares? So that kind of fining structure, whilst it's there and it's relevant and important, is there, but it's maybe not as important at the moment for the public view. The public view seems to be acting in a stronger way than the regulators can. And I think a fine may be issued and forgotten by tomorrow, but the public's view of a firm that they don't seem and don't see to be doing the right thing could last for years, because reputational damage can last for years. And reputation, the public care about what's right or wrong. They don't necessarily care that you've had a fine because you've breached some rules, but actually you haven't done something against Putin. Well, that's wrong. And so they expect it's easier to comprehend, it's easier to deal with. So I think dealing with that is going to be a huge issue.
Excellent. Thank you, Martin. I know you mentioned fines already. We mentioned the reputational damages. What are some of the other risks for a company if it fails to enforce a sanctions order? Are there anything else companies should keep in mind?
Yeah, certainly. I mean, one of the things that I'm reluctant to use the word famous, because I don't think I'm famous at all, but anyone that knows me is always says, this is what he always says. He's famous for saying this. So one of the first things to remember is that you may not be a bank, but your bank is. And your bank most certainly will have a US dollar clearing license. So the first thing that banks need to consider for the risk of breaching sanctions, if they're US sanctions, is the US could remove your US dollar clearing license. Or the US through OFAC will put in place a monitored agreement. So it's part of the deferred prosecution agreement, and you'll have to, for example, have all of your US dollar transactions cleared through an independent monitor. There is the issue that you'll have firms trying to manage their sanctions risks as best they can, but at the same time, their bank wants them to do more. So the firm will be doing one thing, their bank wants them to do another, because they don't want to risk their clearing license being lost. They don't want to be put into special measures, as in under a deferred prosecution agreement, so that they don't have to get all of their US dollar transactions authorized by a monitor before they go through. So from that perspective, it's the first thing firms need to think about is that they have dual control almost. Again, you have the sanctions orders, and you also have what your bank would require you to do. So from that perspective, if you're not a bank, then one of the risks of breaching sanctions is that your bank may offboard you as a customer and say, we don't want you, you're too much of a risk for us, because we as a bank, we don't want to lose our clearing license, we don't want to get in trouble, so we're going to offboard you as a customer. If you are the bank, then your risk is losing your clearing license. If you have a US base, the US may remove your license to trade in the US. Wherever you are in the world, incidentally, you could have your license to trade revoked because you've breached that country's sanctions orders. Obviously, there's fines, there's deferred prosecution agreements, settlements. The interesting thing about deferred prosecution agreements and settlements, of course, is that firms are almost offering up their own suggested penalty for their alleged offences. And you never quite know whether it's almost betting against yourself, isn't it? Because you never quite know whether that person or that incident, whatever you've done, would actually attract the amount that you're offering in settlement. You've offered to, we'll pay 2 million in settlement, and the authorities think, well, it's okay, we was only going to fine you 1 million, so that's that's fine. So you never quite know whether you've pitched at the right level there. But needless to say, so that issue still exists. So you could be fined, you could go into deferred prosecution agreements, settlement agreements. Individuals can be targeted. So as part of a deferred prosecution agreement, the individuals responsible for the breach could be the condition. One of the conditions of the deferred prosecution agreement could be that they're identified and sacked. So there's personal accountability. You've got, obviously, in various different guises around the world, you've got a kind of senior managers responsibility regime, whatever it's called. So senior managers could be identified and sacked, and that tends to be a bit of a barrier to finding alternative employment when you go to your next company and they say, why did you leave your last one? Say, just because of the role I played in breaching sanctions orders, nothing major. So you have that kind of that risk there, and then obviously you've got the the potentially ultimate risk that you could be sanctioned yourself.
Right.
There's nothing to say if you keep breaching, or if you breach significantly, that the authorities won't make you a sanctioned entity, and then nobody can do business with you anyway. And so you become ostracized throughout the international community. You're removed from international trading markets, and your business would go bust because nobody can do business with you. So the risks, and then obviously the other risk that we've already spoken about, the reputational risk. Sort of the public seem to be getting quite well versed and getting to grips with sanctions quite quickly. They don't, probably by their own admission, the vast amount of public don't necessarily understand them. Certainly to their full complexity. But I think they understand the purpose behind them, and they expect firms to adhere to them. So the reputational risk of not adhering to them can be huge as well.
Excellent. Thank you, Martin. Before switching gears a bit, I forgot to mention at the beginning, we have a briefing document that Martin has prepared for listeners. So if anyone is interested in receiving that once the webinar is over, you can email me, email us at IGCA. It's info@igca.org, and we'll be happy to share that with all of you. So just wanted to throw that out there in case some of you are interested in actually receiving this briefing document. So let's switch gears a little bit. I think we've covered the sanctions pretty well, which is the topic du jour, as we said. And let's look now a little bit at money laundering. So when it comes to money laundering, nothing changes, yet everything changes. This is a quote that you used when we were speaking about this. What's hot these days in the world of AML? Well, like what should people keep an eye out for? What's trending? What's some things to consider in that area?
Yeah, I mean, I think I don't know. For me, it's a very true statement. I mean, money laundering prevention in various guises has been around for 20, 30, or money laundering legislation, prevention, all those kind of things, 20, 30, 40 years, arguably longer in some places. So it's always the topic that's there. Everyone accepts it's there, but it's kind of, unless there's a fine issued or there's anything in the news about it, it tends to be just accepted as part of BAU almost, and there's so much that goes on in the money laundering world that, as I said, in that quote to you, is that nothing changes yet everything changes. I think one of the things that's certainly changed is that we're seeing a shift in understanding, which is quite good around money laundering. So, but by that what I mean is that the firms have so heavily focused on money laundering prevention for years. Yes, it carries heavy penalties for getting it wrong. Yes, it has associated legislation to it. It's serious, absolutely. But actually, it can't exist by itself. It has to have a symbiotic relationship with the predicate offence that generates the proceeds of crime that need to be laundered in the first place. And so I think we're seeing a bit of a shift change now in the way firms are viewing it, which is great, because it's almost, if you can eradicate the underlying issue, then you won't have the money laundering risk in the first place, because it's only because fraud has occurred somewhere, for example, that money needs to be laundered. So the more we can,
or something,
the more we can focus on those kind of crimes and getting to the root cause of the crimes, which of course is not our sole responsibility, but in the financial services sector, largely obviously that's law enforcement's job. But the more we can get to grips with the information that we hold, realizing how much intelligence we actually hold for individuals, whether they be criminals, terrorists, suspected terrorists, whatever, the amount of information we hold within financial services is astronomical. And I think this was one of the things, I know it's a long time ago now, but this was one of the things that was really highlighted following 9/11. The level of information we hold and the ability for financial services to contribute to law enforcement and to the fight against terrorism is really quite amazing. And we think that we only have certain pieces of information, but actually, if you analyze it, how much data we have, how much we collect under our banner of customer due diligence is absolutely amazing. We know virtually everything about everybody that we deal with. So particularly banks. I mean, banks know so much. They know who. Just look at your current account, and they can see everything about you, who your utility companies are, where you shop, how often you shop, all where you get your petrol, all those kind of things. So there's a lot of information. So we're starting to see that shift, which is great. I mean, some of the other things that are happening, which provide some interesting points. In the UK, we're about to introduce a levy for certain firms, an anti-money laundering levy that they have to pay. as part of their registration. And for some of the firms, the big firms, that goes up to £250,000 every year as a levy. So there's it's almost again, I think it's been calculated on the basis of the financial services sector is the sector that is most at play within the money laundering sphere, so they should be the ones that are charged these levies. So we've got some some almost you're paying penalties before you start now, which is quite interesting. So we've got levies to think about with things like that. Then we've got the European new anti-money laundering regime in Europe, which has introduced some interesting concepts. I mean, we're all now familiar, probably through news articles and such, around the beneficial ownership piece of being able to identify overseas investors in property and ownership of property. Again, largely linked to sanctions, or driven through sanctions, to be able to identify where wealth exists. And the same in the UK as well. We've had a slight tweak to the unexplained wealth orders regime. So law enforcement no longer have to be able to prove at a higher burden that there's a reason for the order. It's more about the reasonable grounds associated to the wealth that you have, and being able to issue an order for that. Some of the aspects in the European regime with the trying to shift due diligence reviews into a 5-year cycle. I mean, I can see the logic behind that, but it kind of then removes the firm's ability to apply a risk-based approach, and it kind of moves us back into somewhere we were around 1990 to 2000, where we have an actual source book that says these are the rules that you have to apply. And then so firms will obviously start to struggle and panic about those things, that they've got to try and make their systems fit these rules. And if you've previously identified someone as high risk, and you want to review them every 3 or 6 months even, and now this is moved to put it into a wider review period, then that's obviously going to remove some of the risk of risk for management for firms. Some of the other spaces that we've seen movement, obviously there was some interesting statistics issued recently around FCA enforcement actions in the UK since 2020, and some of the areas there that they found missing. I think there's the findings were something like 100% of all of the notices, the final notices, the fines, had criticism to some point, varying greater or lesser degrees, around policies and procedures not being up to date, not being accurate. And some of those things, it's very sad, because it's little things that have been missed that the regulators pick up on. And I've seen for myself, that, and everyone knows, if they have a regulatory visit, their policies and procedures, in the most case, have been reviewed within an inch of their life, and the ink is still wet on the pages as they've been printed off as the regulators are walking through the door. But what's been missing is the version control hasn't been updated, or the page numbers aren't updated. and often it's those small things that let them down. Because, and I generally have seen it for myself, where the regulators haven't looked at the content. They've simply stopped at the version control and said, if you can't get that bit right, why should we bother looking at the content? The fundamental pieces, the bits that we often forget. So there's some interesting points around that. I think I've just written it down somewhere as well. So 45% of final notices issued by the FCA identified failings in training material or training regimes. And that's a huge shame, because training is one of the key controls that a firm can put in place. Often training is seen as a nice to have, but actually it's absolutely key. It's the one part of the regime that should be in place. And often the reason it should be in place is because it's the only time that you get to talk to all of your staff about the same topic. We have attestations. Have you read your AML policy this year? Yeah, we have those, but in reality, we know that staff don't read them. They skim through the policy. Maybe if there's a bit that says you've got to click on a bit at the end, they'll click to the bit at the end, and say, yes, I've read it. And we know that's true because we only have to examine our own behaviors when we're signing up to any kind of contract. It says you've got to read the terms and conditions and click, yes, I've read them. And most of the time people just click, yes, I've read them, because they want to get on with whatever it is they're ordering, doing, whatever. So, those kind of things. And that's where, so people are saying, staff say, yes, they've read the policies and procedures, they understand what's expected of them, but they don't necessarily. And then what happens is that they, that their training isn't as up to date as it could be, or the training isn't really reflective of the business model anymore. It's it's a while since it's been updated, and that's obviously where the FCA found some failings. In other areas, obviously, we've seen some UK examples with HSBC and NatWest and Credit Suisse all being fined quite significantly over the last year or so. UAE was put onto the FATF grey list. Despite its efforts to bring itself up to speed, it still managed to find itself on the grey list, which isn't very useful for them. What else? So beneficial ownership has been a topic of discussion through the Financial Action Task Force as well, and obviously the requirements for firms to understand beneficial ownership better. Particularly for international operations. Again, quite interesting because it's been something that's been around for quite a while. But I still think, largely speaking, when firms are challenged on explaining beneficial ownership within a structure of one of their clients, they do struggle. It's not something that they necessarily explored as fully as they should have. And I only say that from my own experience of dealing with clients, and the fact that it keeps remaining as a recurring topic amongst all aspects of regulation and recommendation. FATF are talking about it again. The EU have talked about it again. The FCA talk about it again. Everyone's talking about it continually. So there's got to be something that's disconnecting somewhere. Then the real estate sector, the Financial Action Task Force are issuing draft guidance on the real estate sector. Because they've identified that as a market that criminals are very attracted to. And I'm not going to go into how the real estate sector could be beneficial to criminals, because that kind of that makes it this is a conversation about money laundering prevention, not how to do it. I mean, that's the kind of upside to the job I do, is that when people say, if you understand how to prevent it, surely that means you know how to do it. Yes, I do. That side is obviously more risky but often more financially lucrative, but certainly carries greater risks. So yes, real estate is a huge market for criminals. Even, gosh, it's some years ago, there was some research carried out by the NCA, the National Crime Agency, and they produced some statistics that showed 54% of all criminally detained or restrained assets were related to property. And you think it's not surprising. It's not surprising, and why wouldn't it be? It's a pretty good investment, isn't it? And in some jurisdictions, they still operate in cash, even for buying properties. So when those jurisdictions still allow properties to be purchased in cash, and cash is synonymous with money laundering, you're kind of like, okay, put two and two together, and you're going to get a lovely market, aren't you? So, so there's quite a lot of work going on in that area as well. So the EU new regime, again, intended to harmonise money laundering prevention throughout the European states. I'm not sure it will. If I'm honest, I think it'll have best intentions and best endeavours. I don't think it necessarily has done. If it's split in two, as I've read it, the EU regime is split in two. There's some things that will be regulation with a capital R, and some that will be directive. And those that will be directive will be interpreted and transposed into jurisdictional law as countries see fit. That's not necessarily going to create harmonization. If I'm honest, GDPR was intended to create harmonization across Europe, but I don't think it strictly has. And I know an awful lot of countries that haven't fully implemented all of the requirements of the fifth European directive still. So that, so I think, that there's best intention, and then there's actual reality. I think it's intended to harmonize things and to make things stronger. But in reality, whether it does or not is a different matter.
Excellent. Thank you, Martin, for that quick summary of what's going on with AML. We have one last question. I know you touched upon it a bit, talking about the FCA and the 45% of final notices identifying that there's failures in training programs.
Mhm.
So let's talk a little bit about training and compliance. Given that also IGCA is, a body that certifies professionals and provides training to professionals. So I think it's a good kind of last question to tackle here. So what's the role training and executive education plays in helping firms meet their regulatory obligations and establish a strong culture of compliance? What are your thoughts on
Okay.
that, Martin?
Yeah. So as I touched on it, I think training is possibly the biggest tool of defense that any firm has, although quite often it's seen as the luxury, it's the nice to afford. If we've got money left over in the budget, we'll provide some training, or it's kind of that training. Well, the training we had last year is still there and it still works, so let's roll it out again. And I don't necessarily criticize that approach per se, but it's how that message comes across to employees that's the important part. Although, as I've just gone through, like very high level, half a dozen things that are changing in the world of AML, but actually, things don't change that often that you need to update your training. I mean, there's some interesting moves and interesting things happening, but that doesn't necessarily mean that how money's laundered, the processes, the procedures, etc., change for a firm. So quite often, the actual material is still relevant. And it is a challenge to say, well, how do we update it? How do we refresh it to make it different so that, firms and employees can see, this is a new course. The interesting downside to that, though, is if you don't do that, then your employees see, oh, this is the same training we had last year.
Right.
So first of all, they just do the click through thing because they think this, same as last year. We don't have to do this. We don't have to concentrate. We'll click through it. It's kind of worse when you only operate in a e-learning environment. If you don't have any face-to-face training, don't have the ability to pull people into the training. And when they're undertaking e-learning, obviously they're kind of doing it in their own time and at their own pace. So you can't check really, are they reading this or are they just clicking through? So without refreshing it, even if there is no new legislation, regulation, policy or procedure that dictates that refresh, if you don't refresh it, then your employees just simply click through it. And as I said, I think it's arguably one of the strongest defenses because we think our defenses are our policies and our procedures, but in reality, how many people actually read those policies and procedures? I genuinely don't think many people do. Some people will, but I don't think many people read them on an annual basis or any more or less frequent than that. And we know what happens in real life is if you want to know the answer to something, you ask the person sitting next to you.
Right.
You don't think, oh, I know, where's that 27,000 page document that I once read? Yes, obvious exaggeration, but you don't go off looking for that policy document to try and find in that document what you should do. And there are probably 2 or 3 reasons for that. First of all, we're humans, and so we're a bit like water in that respect, and we follow the path of least resistance. And so actually finding a document, trying to find within that document where something is, and then understanding it is hard. Versus, shall I ask the person next to you? So you ask the person next to you, and then if you actually test that situation, what you find is you say to the person next to them, so how did you know that? They say, well, I was trained by so and so. Okay, well, where are they? They're over there. So you go and ask them, how did you find out about this procedure? Oh, I was trained when I joined by Fred. Okay, where's Fred? Oh, he left 5 years ago. Okay, so what you've now got is someone following procedures that were trained to one person 5 years ago. That person's passed them on to someone else, and that person is now passing them on to someone else. So they're out of date. They're not necessarily relevant, and you've got people following things that that just aren't correct anymore. And the other reason that staff don't look at policies to find out what they should do and what the requirements are is because invariably they don't understand them, and that's one of my biggest frustrations stroke criticisms of firms' policy documents. They're not written with the employee in mind. They're written by the MLRO, the compliance officer, and they're full of lovely words and expressions. Yeah, absolutely. But they don't speak to the individual. The individual looks at them and goes, I don't know what that is. And so they, in order to understand the requirement, having gone through the pain of finding the document, finding the relevant section of it, they then don't understand what it actually requires them to do. So that places them in a difficult position, don't forget, as well, as a slight aside, because they can't now go to compliance and ask for an explanation of what that part of the policy means. And the reason they can't do that is because they completed their annual attestation only a little while ago that says they've read and understood the policy. Well, if they had read and understood it, they would have come across this section that they don't now know what it means. And then they wouldn't have said, I read and understood it. They'd have said, actually, I don't understand section 2.6 or whatever it is. So they can't now raise the fact that they don't understand part of the policy because they've already confirmed that they've read it and they did understand it. So that creates a barrier for that because they can't now admit that they've basically lied on their attestation. So they just won't go to the policy. So the only way you can communicate that policy effectively is through training. And it's the only way you can make sure that what's in that policy is communicated to staff effectively, efficiently, and with the messaging that you want delivered as if they were reading your policy. And as I said earlier, I think training is often seen as something that is a luxury, something nice to have. If we have money left over, we'll spend it. If we haven't, hey, we'll use the same model as last year. And I think one of the biggest criticisms that all regulated firms get from all of their regulators is about culture, conduct and culture, conduct and culture. It's what we hear all the time, and it's right. And if you think about it, what kind of message does that send to staff? We haven't bothered to update our training. We're not doing anything new, and we just want you to do what you did last year and maybe the year before that, or even the year before that. So that tells employees and staff that actually this isn't an important topic for my boss. For my company doesn't take this matter seriously because they're not investing in training. If they did take it seriously, this would be a new course. This would be a revised course. There would be different requirements. The assessment at the end would be a different assessment. There would be employees only go with what they see, and what they see is no investment. So they actually think, well, this can't be an important topic. And so from there you start the slippery slope. They think, well, actually, why do we need to do anything? Because if they can't be bothered to train me, hey, it's not my problem then. And we kind of then hope that these things are picked up through whistleblowing regimes and things, but actually invariably they're not. Employees just think, well, it's not my problem, I won't get fined. It will be my employer's problem, they'll be fined for not training. And so you end up with this kind of really toxic culture. Of course, depending on where you are in the world with your legislation, also depends on whether that lack of training acts as an adequate defence for money laundering in a court of law. In the UK, it certainly does under the Proceeds of Crime Act. If you can prove that your employer didn't train you, then any offence that you commit can be defended on the basis that you weren't trained not to do it. So training is vitally important. I think it's a very underestimated tool. It's seen almost as an automation. It's something that we do. It's procedural, and I think that's one of the biggest mistakes. And I think the FCA findings from their final notices, 45% of final notices related to inadequacy of training, and a lot of it was about the fact that the content just simply didn't reflect the business. It didn't reflect the operations. Didn't reflect the procedures, the risks of those procedures, the risks of the products, the risks of the services. It just wasn't tailored enough. And even electronic learning can be tailored. It's and it should be, because otherwise, it's you're just training everybody in the industry with the same message. And I think long gone are the days when money laundering is something that's done through placement loan and integration, and here's some cash and it's been passed from one man in a dodgy coat to another man in a dodgy coat, and that's it. As long as you spot that, you're okay. It's way past that now. It's far more complex, and the way it's the risks and the exposures are far more complex. And that needs to be reflected in the training.
Excellent, thank you, Martin, for that comprehensive answer on or comments on training in the compliance world. Just as a way of concluding this chat, we're reaching the end of the webinar. Can you tell us what to expect, 1 year from now, 2 years from now, 5 years from now, in terms of financial crime prevention? Where is this sector headed? Any sort of idea, or what are your predictions? Just to kind of round things out.
It's not going to get any better, I can tell you that. Obviously, in reality, I have no idea. I have my own personal views. I think we're going to see all of the markets previously unregulated becoming more regulated. So, there will be a much stronger view to pull in all aspects. Obviously, we've seen the fifth directive bringing in things, high value dealers, art dealers and things. We saw the US Treasury issuing a notice off of the back of that almost to say, and we consider art to be a tangible and movable currency almost. You know, you can trade with art. So we know that there's, you know, all of those people are being bought in. Company service providers, casinos, real estate is being bought in. You know, that we've seen moves in the UK around crypto firms, particularly with crypto ATMs, with the FCA kind of saying, don't bother applying for authorization, we're not going to give it. So I think things will get tougher for the firms that are in existence. I think it's going to be harder to get authorization. I think there's going to be a lot more people. I think the interview process, the selection process and appointment process, as you know, significant persons in whichever country you're in, whatever role, senior management roles, whatever they're classified as, that's going to get tougher. I think there's going to be far more personal accountability, because again, I think the regulators have pretty much got to grips with the fact now that, you know, banks or firms, whatever, insurance companies, accountancies, whatever, they're just organizations. And they've been moving away since about 2015 with the introduction of various senior management responsibility regimes, and they've been moving away from that piece for a while, saying actually we will hold you personally responsible. I know it's a very generalized term, but I think, you know, long gone are the days where the regulator will accept that on the 1st of January, when you do your annual budget projections, that you put an amount aside to pay any fines. You know, they would much rather you see that you invest that money up front in trying to prevent something going wrong than simply putting it in a pot for a rainy day and paying a fine. So I think there's going to be much more personal accountability. We'll see. I think there's going to be a requirement to have things to have financial crime controls more heavily aligned. So you know, not operating in silo within firms. So, you know, fraud departments, bribery departments, sanction departments, compliance departments. I think there's going to be a move, whether it's, you know, whether it's dictated and prescribed or whether it's you know, voluntarily entered into. But I think we'll start to see a need to have those lines tied up more and to be more firmly aligned together. And I think one of the things that would possibly drive that is what we've been talking about at the top of this call with resource. You know, so where there have been, you know, where firms have got these kind of siloed functions, I think they would have seen the benefit of, well, actually, if we all work together, we could all have done this in the first place. So I think, you know, these kind of various financial crime roles and departments, compliance roles, risk roles, I think we'll start to see them sort of like coming together a little bit more, so that firms have an overall department that they can call on when they need to, as they are now. Regulation will just get tougher for sure. Coming out of the back of what is going on in Ukraine, it's difficult to know which term to use, but what is going on in the Ukraine, coming out of the back of that, and at the same time coming out the back of the pandemic, I think we'll start to see a shift, very heavy shift in regulatory attention. The regulators will want to see how firms have been running their business during the pandemic. I think we would have possibly started to see some of that going on a little bit more aggressively had we not had the Russia-Ukraine issue to contend with. But I think we will start to see the regulators coming out saying, okay, so what did you do during the pandemic? How did you control, you know, what was your operational resilience? How did you go into, you know, business resumption plans and all those kind of things? How well did you do? How much did your customers suffer as a result? And then they will then, off the back of that, start to say, okay, so how did you manage your sanctions? So where were your exposures? Did you identify your exposures? We know you had, you know, unprecedented demands in relation to sanctions, but how well did you control them? You know, did you find all of your issues? How did you manage those issues? What happens if you didn't find any issues? I mean, that's almost worse, isn't it? I mean, the fact that you didn't find something that had gone wrong, you didn't know about it, that's the worst case scenario, really. You know, identifying an issue and dealing with it, good. Identifying an issue, not quite getting around to it, but I've got a plan. Okay, you might get away with that, but didn't identify I had an issue. That's never going to sit well with the regulators.
Of course.
So I think there'll be there'll be some regulatory attention around, you know, operational resilience and sanctions compliance specifically. I think once everything all settles down, for want of a better term. And then I think the final thing, there'll be an increased move still around consumer duty and vulnerable customers. It's something that's not going to go away, and rightly so. I think there are so many instances where firms just do not offer flexibility in products, services, or anything else that allows customers who are suffering through whatever kind of vulnerability to be able to deal with them effectively and efficiently. I mean, a prime example, I was talking to a mortgage client only a couple of weeks ago, and I said, so if a customer phones you and says that they know that they've been put on notice, they're going to be made redundant, they've started looking around, they're not hopeful that they're going to find a job by the time they're made redundant, so can they instigate some kind of payment plan now? What would you do? And their answer was, well, we'd tell them to wait until they were redundant. Okay, so they've already told you that they're going to be in an issue. But your solution to that issue is to make them go into default on their mortgage, and then you'd put them into a payment plan. And they said, yes, we can't put a payment plan in place until they've defaulted. Why? Why can you not try and stop the problem happening? The customers even identified the problem for you, but you're still going to allow the problem to manifest before you react. And that's the kind of move and things that that the vulnerable customer piece is trying to address. And I think there's going to be a huge emphasis in that, and I think that's what we can see with consumer duty and all those kind of things coming out, so that we take responsibility for the people that we offer our products and services to. And that's what we should be doing. We're supposed to be financial services. The key's in the services part, isn't it? So we need to service, not to just sell and run.
Excellent. Thank you, Martin, for this lovely chat. You did most of the talking, of course, since you're the one with all the knowledge here. But thank you for participating. I think it was very insightful, and I think we got a lot of topics covered that are trending in the financial crime prevention world. I'll get some admin issues out of the way, and I'll say goodbye. To everyone listening in, I mentioned that we have a short briefing that was written by Martin covering some of the topics that we discussed today. If you're interested in getting a copy, just email me, info@igca.org, and we will send you that copy. We will also be releasing the audio recording or video recording and the transcript within the next couple of weeks. So stay tuned for that. I will make sure to email everyone with a link to the transcript and to the recording, and maybe some other goodies on behalf of IGCA. So yeah, with that said, Martin, thank you very much once again for participating, and we hope we get to do this again sometime soon.
Indeed, there's just something, I've just seen something flash up in the Q&A box. I don't know if that's a question.
Please repeat the email. I will type it for everyone now. 1 second. I will send everyone my email address right now. Let me just drop in the chat to everyone. Everyone, info@igca.org. Just email me here for the briefing from Martin. Excellent. I'll give people a chance to copy that, but make sure everyone gets that. But info@igca.org. So Martin, thank you very much once again. And
thank you very much indeed.
Be in touch. Excellent.
We'll do.
Thanks,
Lovely.
everyone.
Thank you.
Bye.
Cheers. Bye-bye.